A new energy war. China is losing access to cheap oil, and it changes everything. What if I told you China is quietly running out of cheap oil, and if it happens, it changes everything in 2026? Here's why. If China runs out of cheap oil, and if that keeps up, the world will find itself in an energy flow war. And this may become one of the most important geopolitical shifts in 2026. Welcome to Geopolitics Unplugged. Today we're answering a simple question with huge consequences. Is China losing access to discounted energy? Is Venezuela now effectively under U.S. control? Is Iran becoming too risky for China? And if so, what happens when the world's largest oil importer can no longer buy cheap? We'll answer those questions today in 5 parts. Part 1. Why does cheap oil matter to China? Well, China burns over 11 million barrels of oil per day. That oil powers industry, manufacturing, shipping, and exports worth $3.6 trillion a year. For years, Beijing solved one problem brilliantly. It bought from sanctioned producers to keep costs low: Russia, Iran, Venezuela. In 2025, those three supplied 40 to 50% of China's energy imports, often at $10 or $20 below Brent. That discount was not a footnote, it was a structural advantage. Remove it. Well, the entire export model starts to strain. Part 2, Venezuela is basically gone. In 2025, China imported 500,000 to 600,000 barrels per day from Venezuela, mostly through oil for loans. Then January 3rd, 2026 happens. Maduro is captured. The United States takes control of PDVSA sales, and Chinese imports collapse by roughly 75%. Washington says to China, you can still buy Venezuelan, but not at debt prices, not at discounts, at full market rates. And most of what was China's Venezuelan heavy crude now flows to United States refineries. In plain language, Venezuela is no longer Beijing's discount trap. One of China's cheapest sources just closed. Number 3, Iran is becoming very risky for China. So China leans even harder into Iran, about 1 million barrels per day. But since late December, Iran has been destabilizing. Protests, unrest, escalating military risks. Markets have already added $3 to $4 per barrel in risk premium. If Iran exports are disrupted, or their thoughts of a U.S. or Israeli strike, or tanker seizures, or Strait of Hormuz drama and issues, models show that Brent could spike by $10 to $15 or more. For China, that means higher refinery costs, higher fuel prices, and serious stress on its independent refineries. Iran is still flowing, but it's no longer safe and at great discount. It is about now geopolitical gamble that's narrowing the discount quite a bit. So part 4, what's left for China? Russia remains China's last reliable cheap source, about 20 to 25% of its imports. But that deepens the dependence on Moscow, which is always problematic. It's always best to diversify, so who's really left? Now China turns towards our north, Canada. New deals target 200,000, 300,000 barrels per day of heavy crude, but it's not so cheap. After freight, landed costs are about $60, $70 per barrel versus Venezuela's former $40 to $50. Big difference. And there's no guarantee that Canada can actually reliably ship that much given its known transmission issues because of pipeline restraints and cold weather. And now the U.S. threatens 100% tariffs on Canada as it deepens ties with China. So the replacement for Venezuela is more expensive, politically fragile, and not at all physically certain and strategically contested. Part 5, the consequences. If you remove cheap oil, and China's costs are going to rise real fast, a sustained $10 increase per barrel does not just hurt profits. It changes the global economic balance. First, it raises China's industrial costs by 1 to 2%. And that sounds really small, but when margins in manufacturing are already at 5 or 7%, that wipes out an entire quarter's worth of profitability across sectors. Second, it raises shipping costs by 15 to 20%. Container rates rise, export prices rise, and all of a sudden Chinese goods are no longer the cheapest option in the market. Think Vietnam, India, Mexico, all become instantly more competitive overnight. Third, export competitiveness weakens, and exports are not a side business for China. They're the entire foundation of growth, more than $3 trillion a year. So margins compress, inflation rises, and growth slows. Now comes the strategic problem. When growth slows in China, everything else changes. Beijing is forced into very bad choices: subsidize industry and explode financial deficits, devalue the yuan and trigger trade wars, or accept lower growth and rising unemployment. And here's the part that changes geopolitics. Slower growth means less money for military expansion, less money for Belt and Road, less leverage for Global South, less room for strategic risk. Energy stops being input, it starts being a binding constraint on power. In 2026, this is why it matters, because for the first time in 20 years, China no longer scaling up on cheap energy. It is managing decline in energy advantage. And when an export empire loses its energy edge, supply chains shift, alliances shift, and the balance of power starts to move. Okay, the big strategic picture. So is China out of cheap oil? Probably, absolutely, yes. Venezuela is now under U.S. control. Iran is unstable. China's pool of cheap oil has shrunk from 3 pillars to one stable source, Russia, and one risky source, Iran. This is not an immediate crisis, but it is a structural weakening, and the energy advantage is industrial power. When cheap oil disappears, export empires weaken, supply chains shift, and the geopolitical balance moves. So this is the true energy war behind the headlines, and now it's only just beginning. Subscribe for more great insights like this. I'm Justin McShane from geopoliticsunplugged.com. See you next time. Cheers.